Chapter 8. Accounting Terminology and the Accounting Industry. So the purpose of this chapter is to immerse you in accounting technology so you can see that there's different terms for the same thing really, and we'll see why that happens, and also different sort of types of staff member within the accounting industry. It's not going to answer any particular questions in there, but what it will do is it'll allow you to understand the questions a bit more really in terms of what each individual staff member is doing, let's say, or where you look at a term and so you'll actually know which term it is when a different name is used. So in this chapter we'll consider certain accounting technology to allow future chapters and exam questions to be comprehended. This will include where there are many different terms for the same thing. A significant amount of the multiple names result from the shift in 2005 from UK General Accepted Accounting Principles, UK GAAP, to International Financial Reporting Standards, IAS. The shift was due to increased global trade and EU expansion, such as the method of accounting treatment that was required for comparability worldwide. So a method was required for comparability worldwide, and the UK had to move to international accounting standards. All of the pre-2005 trained accountants, including me, will often use old UK GAAP terminology. Like many parts of accountancy, the terms build up over time, but then accountants are replaced, and the reason for the old name change, the old name becomes lost. Don't concern yourself with that. Just simply immerse yourself in the language. So in terms of the terminology that we're going to go through, on credit. Something is described as on credit when it's not immediately paid for by the customer. This is opposed to cash sale which are paid for immediately. Debtors. Any amount to be paid from the organisation that has not yet been paid. Creditors. Any amount due to be paid by the organisation that's not yet been paid. Short-term and long-term debtors or creditors. Short-term typically means less than 1 year. Long-term typically means over a year. Cash sale. In the bank, in or to the bank. This is a sale that's paid for immediately. It does not necessarily mean that it's been paid for in a bunch of a wad of cash. It may have been, and most often is, paid directly into the bank account. Any question should be reviewed to see whether it's actually paid in physical cash or direct into the bank. A cash float. That might be an amount that's held in a till to provide change for any cash sales that are made. So that would be physical cash on site. Trade receivables, trade debtors, customer accounts. So these are all the same different terms for the same thing. Those are amounts to be paid by customers where they've been purchased on credit. Note that when they pay into the bank account, the VAT payable has already been determined when the initial journal was made. Do not recalculate another amount of VAT due to HMRC when you're doing that journal of payment by the customer for their debt they owe. Trade payables, trade creditors, and supplier accounts. All again the same different terms for the same thing. Amounts to be paid by customers when they have paid on credit. Note that when they pay into the bank account, again, the VAT payable has already been determined when the initial journal was made. Don't recalculate another amount of VAT due to HMRC. Sole trader. Sole trader. A single person who runs their own business. This person will still be treated as a shareholder. So although they're an individual, they're still treated as a shareholder outside of the organisation. So there's the organisation, whatever this plumber is doing. Joe's Plumbing is Joe's Plumbing, the organisation. The sole trader is somebody outside of that who actually owns Joe's Plumbing. The person is still treated as a shareholder and separate to the organisation which they run. Their ownership still represents capital and a money out item. Partnership. That's a group of people who own and run their business. As with sole traders, they are separate to the organisation, and their ownership and profit represents a money out capital item. Limited liability profit. Both sole traders and partnerships have unlimited liability for their debts if their organisation goes bankrupt. So, for example, Joe's Plumbers, they're going to lose their house if they burnt down somebody's house while they were plumbing. A limited liability partnership is a partnership whose liability is designed to limit the liability of those partners only to the capital in the business. Private company. A limited liability company owned by private individuals or organisations. So the liability of the company is unlimited, but the liability of the owners is limited now to the capital in the organisation. Public company. That's a limited company that may offer shares to the wider public, although in reality the extent that they can do so is limited without a formally approved prospectus. That's costly to create and involves considerable liability as well. Quoted or listed company. So this is a public company that's quoted on an exchange such as the AIM, the Alternative Investment Market, or listed on the London Stock Exchange. These are large companies offering shares to the public, so they really do offer shares to the public, and then they have the proper prospectuses to be able to do so. They're mainly owned by pension schemes. That's the main investor on them, and there's a market that's trading in their shares. So, for example, Shell PLC. Limited or unlimited liability. Unlimited liability means that the owners are liable for all the debts of the organisation if they cannot be paid. This means the owners will lose their houses or their cars if the company goes bankrupt. Limited liability places a cap on the amount that's liable in the event of bankruptcy, and limiting the liability to the share capital. The cost of the limited liability is disclosure of financial information to Companies House. We'll go through company structures in a later chapter. Limited liability has its limits. Directors become responsible for the debts if they trade whilst insolvent or if they act recklessly. The company may have unlimited liability. The company itself, though, has unlimited liabilities for the amounts due. You just might not be able to pay in the end. Irrecoverable debts. It's possible that customers may not be able to pay their debts if they go bankrupt, and as a result, a sale on credit may not be recoverable in full. Where the debt is lost, so we actually know the specific debt is lost, it's called irrecoverable, and it's an irrecoverable debt expense. So we don't just sort of write back the sale, we actually have an expense called irrecoverable debt. Going concern. This is a company that is not likely to be bankrupt in the next 12 months. So the company is a going concern. It's not likely to be bankrupt in the next 12 months. Auditors. Because of the threat of limitation of liability poses for creditors and a limited because limited liability is a threat, really, isn't it, for its creditors? They may not be able to, this company might not be able to pay, and therefore, the creditors might lose out if it goes bankrupt. And because of that, a limited liability organisation will have to have their financial statements audited before they are provided to Companies House. The extent of that audit and the extent of the information that needs to be provided is determined on the size of the company, but typically auditors audit and they provide an opinion whether the numbers are true or fair in that sort of set of financial statements. Directors. Directors are nominated individuals who have oversight of the operations of a company. They might be executive directors, so they manage the company, or they might be non-executive directors, so they don't manage the company, but they have oversight. Returns. When goods or services are returned for any purchase, in purposes of introduction to bookkeeping, returns are when goods or services are returned for any reason and a refund is requested. Petty cash. A small amount of on-site cash for the payment of incidental expenses. You might get questions on that thing as a term. I've seen that as a question. What is petty cash? And it's a payment for incidental on-site expenses. Casting and miscasting. Casting is the addition of numbers. Miscasting is where they're added incorrectly. Transposition. That's the transfer from one place to another. So if numbers are transposed incorrectly, there's a transposition error. So let's say they're transposed incorrectly from, let's say, the sales daybook into the sales ledger. That's a transposition error. You might see that as a term coming through. Bulk. Bulk is a large amount, we're typically referred to where above such an amount there's a discount offered, a bulk discount. Trade or in the trade. An organisation that's not a member of the public and instead an organisation including sole traders that may look for a trade discount. For example, plumbers may receive a trade discount from a builder's merchant because of their regular purchases, whereas a member of the public would not receive a discount for a few taps. Prompt. Undertaking an action within a set time. So, for example, payment within a set time to achieve a discount, so a prompt payment discount. Discount for cash. It's a discount for immediate payment. So effectively it's a prompt payment it's done for straight away. If it's a discount for payment in cash, there also has a potential for the payments to be made so the seller can avoid VAT by not declaring the sale, so they don't put the VAT through their book. Clearly that's assisting them defraud HM revenue customs. You shouldn't do that if you're suspicious of it. Direct debit. A regular but variable amount that we pay from the bank account that is set up via a direct debit mandate. So typically, let's say you've got an your energy bill, and they say, well, can we have a direct debit? And then your energy bill is going to fluctuate around there, though, so it's an amount that's going to be taken out. You've given a direct debit and tell them you can take out whatever you want out of the bank account, and then it's going to move around. Standing order. That's a regular and a fixed amount to be paid from the bank account. It's set up via a standing order mandate. So it's like a direct debit. The company's going to take the money from your bank account, but this one it's fixed. It's a certain amount. So let's say £100 a month or whatever. Inventories or stock. Goods and materials held for future sale or the creation of product. Tendering. Where a number of organisations go through an exercise in order to obtain a sale with one or more of the organisations being successful. So they go through a tender exercise, and they bid for the work, and then one of them gets awarded a tender. Quote or quotation. An offer by an organisation to supply certain goods or services at a certain price. It may follow a negotiation. It might not. It might just be a list of sort of things in a brochure. Equity. an amount of assets after liabilities have been deducted. It can also, in members of the public world, it can also be another word for capital. Let's say the amount of equity in a house after any mortgage payments have been withdrawn. So the equity in a house, what's the house worth minus any mortgage on it. But from a point of view of a company, equity is the amount of assets minus liabilities. Financial statements. Formal statements of financial performance and position of a company and associated notes and descriptions. Their format and extent is determined by the type of company. You'll do that in different units, but you'll note that there might be some reference to financial statements. Profit and loss account or income and expenditure account. We'll go through that in detail in a later chapter, but basically this is a financial statement showing the financial performance of an organisation between 2 points in time, typically a year. It's the profit and loss account for a company and an income and expenditure account for a non-profit organisation. Typically you're going to see a reference to profit and loss account. Statement of financial position or balance sheet. The financial position of an organisation in time showing its assets, liabilities and shareholder capital. So it's position, and then so position is statement of financial position, the balance sheet, and then the profit and loss account is the performance over a period between two balance sheets essentially. Segregation of duties. The separation of tasks in the finance department amongst its staff members such that no one person has overall control and ability to manipulate the financial system in order to be able to commit fraud. Now, in terms of the accounting industry, well, I'm going to take a bit of time just to go through that one. And typically what you'll see here is you won't see questions on the accounting industry, but you may see sort of references to particular staff members. So in an ethics question later on, you may see in later units, you may see a reference, let's say, to you being the junior in a practice. There'll be a manager in between you, and then there'll be a partner. And typically the manager is telling you, intimidating you to be able to do something that you shouldn't do, and the answer is to refer them to, or tell the partner about it, really. So we'll go through here in terms of what actually some terminology that is about how the accounting industry works. So practice versus industry. So practice refers to an organisation of accountants who offer accounting services such as bookkeeping, audit, special work for clients. They are run by partners and will have a high proportion of accountants, if not all of them, who are either professional accountants or trained professional accountants. In practice, they'll typically be chartered accountants as well, and therefore there'll be a firm of chartered accountants, and as a consequence, the partners will have to be chartered accountants. Usually, typically, for at least 75% will have to be chartered accountants. Industry refers to a finance department within a company. They'll raise order, invoices, they'll make payments, they'll run the payroll, they'll produce financial information, etc. The finance department will have fewer professional accountants and more technicians. So typically AAT staff members will be in industry rather than in practice. Partners, managers, seniors and juniors and bookkeepers. So we're going into practice. So in a practice, there'll be partners, managers, seniors, juniors and bookkeepers typically. So the partner is the part owner of the accounting practice. They'll typically be a professional accountant, and the vast majority of them will be. You may have one manager, let's say, who's brought in from outside, but typically they'll be a professional accountant, or might be one HR professional. They'll be most often a chartered accountant, simply because so they can call themselves a firm of chartered accountants, and they'll be the most experienced staff members. They'll be expert at communicating with clients and obtaining new clients. That's what they'll be. Senior managers and managers. So these are the manager ones. They'll handle the day-to-day operations for clients. So they'll have and the staff in the department. They'll typically have a list of clients to service, and they'll plan the services offered. It may also be that the partners might handle the department. The staff members will manage them. It depends really. But the manager will handle a list of clients and the day-to-day operations of the organisation. Seniors. So seniors are a person who's not near a manager, and they'll manage an individual job. So managers will handle a group of jobs, seniors will handle an individual job, and they'll direct the juniors on the job. So they don't have line manager responsibility for the juniors, but they'll sort of direct the juniors actually on the job. They'll typically be recently qualified or part qualified professional accountants. Juniors, this person's typically they've usually started their professional studies and not yet attained sufficient experience to be an audit senior and be given allowed to direct the whole job. They'll undertake detailed work on an individual job. So, for example, they'll check the accuracy of a report back to source documents. They'll do typical work. They'll do the same work to the senior, but the senior will be explaining to the junior how to do the work, and they'll also be checking the quality of the work performed. Now, in terms of those sort of breakdowns, partners, senior managers, seniors, and juniors, it will also depend as well on the size of the job being undertaken. If we're auditing Shell, well, it might actually be a partner handling the actual individual job, and that's what they're responsible for. They're just responsible for Shell. If it's an individual, more typically the company will be breaking down as I've just given those explanations. Then we'll have a last sort of group, which will be bookkeepers. Sometimes the seniors and juniors will do bookkeeping tasks in a practice, but the practice might have a separate set of employees who undertake just bookkeeping work, and they'll typically be technicians. So AAT staff members could typically do the bookkeeping work in a practice if that was the practice's main line of work, really. And the reason is because of, on the one hand, cost. The professional accountants cost more, and also as well, the professional accountants probably aren't going to do bookkeeping all day long. They would get a bit bored of that, and they'll also see it as a bit career limiting. So in industry then, in terms of our staff members breakdowns, what types of staff we got? We got the finance director, financial controller, office manager, and management accountants and clerks. So the finance director, or CFO, chief finance officer, the finance director is the senior accountant in the company, and they'll typically be the professional accountant. It's very unlikely that they could be anything else, and they could be from any one of the institutes. But as in practice, they're typically going to come from the Institute of Chartered Accountants of England and Wales, ACE and BACAs, so that they can have the name Chartered Accountants. In industry, they'll be from any of the institutes, and it depends which one they just trained with. They'll work in close partnership with the CEO of the company, and their skills are typically providing clear financial analysis to pick out the main points of the business from a mass of data. They'll either plan the organization's capital structure, so the organization will pay the lowest overall rate to providers of capital. They'll provide strategic decision making over the operations, and they'll have the ability to communicate the cost and income drivers of the business throughout the organization, such that everybody remains focused on what's important. They'll often have other departments reporting to them beyond just the finance department. The financial controller, that person is responsible for the finance department. So they'll typically be responsible for the finance department, monitoring and setting budgets, compliance with financial procedures, producing financial reports, and they'll typically make decisions or review on decisions of the day-to-day treasury management. They'll report directly to the finance director. The office manager and management accountants, and they rank sort of below the financial controllers, and the office manager will typically manage the sort of finance department staff on a day-to-day basis. They'll often be the most senior non-professional staff member, and they might, let's say, do the cash book and whatever, and they might drop into some of the financial controllers sort of operations as well. This is where AAT, typically AAT level 4s are going to be sort of at this office manager kind of level. The management accountant will produce management accounts and reports. They're often a trainee professional accountant, so they'll typically be a sort of a part qualified professional accountant, or a new trainee professional accountant, just in terms of which ones tend to drop into which roles. And then in industry, the last sort of group we've got is the clerks. So purchase ledger clerk, sales ledger clerk, debtors clerk, payroll clerk, those kind of ones. These staff members are going to undertake the day-to-day tasks following procedures typically set out by the office manager or financial controller, and they'll follow the system's notes regarding what to do, and they'll escalate positions issues if they can't record and resolve them. So these are typically the entry-level AAT roles. So often doing AAT, maybe qualified AAT level 2, or maybe doing the AAT level 3, and those they'll typically be doing those kind of clerk roles at the same time. In respect to actually the sort of practice as well, so in terms of the accounting industry and some names you might hear, Big Four, they're the 4 largest global firms offering considerable services in addition to traditional audits. So they'll offer audits and they'll offer considerable additional services. There's continual tension in these firms for merger, either merging together. So when I trained, there were Big 6, and before that there were Big 8 and whatever. They keep sort of shrinking down. But then there's also as well attention for them to separate their services from their audit, so that they can maintain their impartiality. So can audit remain independent when the service fees are earned from additional work? There's also attention in terms of the share of profits. The consultancy parts of the business make the most money and often subsidise the audit. An audit carries the risk of losses from audit negligence, so they might want to split off. Mid-tier, they're not Big 4 firms. They're going to provide a mix of audit and services to on average smaller clients than the Big 4 clients. So the Big 4 clients are going to be very large firms. They can also audit smaller firms as well, but there's a bit of a premium payment being made for a Big 4 service. And then small firms, and those smaller firms are going to typically specialise in either in a particular sector. So they might say specialise in the education sector, so audits to schools or what have you, or academies. So they might specialise in a particular sector, and or alternatively they might offer services to smaller clients who can't afford the larger firm fees. Really. With respect to the question which is often asked, which is the best practice to work for. There's no real sort of right or wrong answer on this one, because I've worked in a range of them and in a range of different departments within them as well. So small practice is more likely to provide extensive experience whilst training. So you probably get a lot more sort of wider experience. You'll see the whole system, you'll see a whole audit and how it's run out. You might do what's known as systems audits as much as just as substantive. So you might sort of do some work for the client in terms of advising them as well, and you can accelerate your learning. It can be a little bit easier as well for some answering some questions, because you will see some real life examples. Whereas larger firms tend to sort of offer more opportunity for sort of special work. Let's say being seconded into the corporate finance department, and for career advancement. You've already got your foot in the door. If you wanted to go into corporate finance, where I went, if you trained within a large firm, you'd already had your foot in the door and you could get across. Whereas I had to do well in the exams and then go across. So with respect to industry and practice, which one you should go into, or which one's better? Again, I've worked in both, and there's no right or wrong answer. It can be more supportive to be surrounded by other accountants whilst training, but in reality, so you can do that. But really, you're going to just get whatever role you can and then move on after some experience. The only thing I would say is that it's easier to go from practice into industry rather than industry into practice, because you wouldn't have the audit experience in industry to be able to then move into practice. So it's a tougher move. If you're making the choice, probably you're going big four practice if you can in there. But similarly, mid-tier or smaller firm practice is not bad in terms of it's not necessarily a worse option. You'll probably get a better training. You just then got to make the leap and do really well in the exams to be able to get into the big four after you've done it to get paid more. Although you can similarly actually the rates of pay can often be quite similar. It's at the partnership level where it starts to be very different. Now, students also as well tend to ask which institute's best. So just in terms of the institutes that you have available to you from the professional ones, and you've got ICAW, so the Institute of Chartered Accountants of England and Wales, so they're ACAs. These qualifiers do more and harder exams, and they require audit experience to be able to qualify. So they're within practice ICAs, really typically tend to be trained in there. There's a few that have been started to be trained in like government organisations and whatever. So they typically tend to be all employed in practice, and whilst their exams are harder, so they do more exams compared to the other institutes, these students do have the advantage of being surrounded by many other professional accountants and students. They'll make up the bulk of partners in practice because of rules over how a firm may call itself a chartered accountancy practice. CIMA, these accountants tend to work in industry. In fact, they're going to work in industry, really. They don't need the audit experience to qualify, and they're going to specialise in management accounting. They will see when they're training. They're going to see one firm in depth, really, or maybe one or two if they move. So they're going to see that in depth, which can be useful. And they're going to probably have more management experience. So there'll be faster management experience. They'll have some staff members under them. However, that may limit the extent of their accountancy knowledge, and they will not have the support of numerous fellow professionals in the same organisation. So you pay your money, you take your choice on that one. ACCA and certifieds, or ACCAs, well, they're called certifieds because the Association of Chartered Certified Accountants. They're a mix of auditors and management accountants. The ACCA's institute was born with the view that ICAW, so the chartered accountants, were too selective, and they desired to expand the number of accountants. They can't call themselves a practice of chartered accountants. They're not allowed to do that now. And AAT was created from ACCA before being separated into its own organisation. Again, it's sort of an industry practice sort of decision. Which one gives the better experience? Which one gives the faster management sort of experience? Which one has the support? Then again, you can see what you can get. CIFA is the last one. They're a bunch of they are accountants who train in government organisations, so they're public finance accountants. Now, actually, you started to see government organisations or government trained accountants tend to be using the other institutes anyway. So, you consider that there. But any one of those institutes, they're all pretty good. Just do your reviewing of them all. But in terms of the DNA of them, the chartered accountants have a view that it's a bit more selective, tend to be harder, and the other institutes don't believe in that, and therefore tend to be a touch easier. But whether you get the same level of support is questionable. And then AAT comes out of ACCA, and those are for the technicians. So all of the above, so all professional accountants and all the technician staff, they're all going to operate to the same ethical standards, and the AAT ethical code of practice is virtually the same as all the other institutes. In fact, it might actually be word for word the same as the Institute of Chartered Accountants of England and Wales is one. So it's not like they've got different rules over what they're going to do and how they're going to act. They're going to do the same thing. It's just mainly where did you train, how hard was the exam. The ACAW have a few extra ones on top in there, but then also how much support you're going to get while you're doing it. Hopefully that's given you some questions anyway for your interviews when you're going for jobs, and also as well some things you might want to consider when you're applying. Although in truthful, you're going to get your entry, get yourself in the door, and then move on from there. Right, chapter 9.